Shenkman, and I'm joined by, I'll call you a friend. You can object off the screen later. A friend and colleague, Christine Pronek, who's really very smart and very good at trust and estate income tax issues. And there are not a lot of folks that are really adept at that. So I'm thrilled she's joining us. And we're going to talk about a lot of really practical issues. And I was going to introduce your firm name, but I just noticed you're wearing a firm shirt that says Wilkin Gutton Plan. So
this one.
That's the other side. So that's the firm in New Jersey that Christine's with. But we're not talking really about Jersey tax. We're talking about primarily federal tax. And if she makes some comments, they'll be helpful across the board. Christine, do you want to say any comments, or should I continue with an introduction?
I mean, I'll just do the quick overview. As Marty said, it's going to be geared more towards federal, and the conversation is going to be the decedent's final individual income tax return and the initial and future estate income tax returns, and just how they work together and elections that are available and allocations. But Marty, I'll let you continue.
So Christine and I were talking before we got started, and one of the points that I want to make, which is really important, and we both kind of agree, and we both try very hard to do this in our practices, you got to stay in your swim lane. This stuff is highly nuanced. The rules are, I don't know if we're going to get into 6166, but I just did a research project on that. To say they're complicated and nuanced is a horrible understatement. They're incredibly complicated and nuanced. And that's just one tiny sliver of the topics that could affect elections for an estate. And if you miss making an election on time, and an election is informing the IRS that you want a particular tax treatment. I don't know if we needed to define that. If I didn't define it well, you can correct me. But if you miss it, there may be no recourse. The IRS may not even be able to give you leniency if you've missed the required statutory date for an election. And one of the things that concerns me is I work with a lot of clients, with a lot of accounting firms. I've worked some incredibly great accountants, but this is not their forte. They may be incredible at partnership and subchapter S returns and 1041s, but this is really a subspecialty. And if you're a CPA or even a decent sized CPA firm, if you don't have a partner who's really dedicated to this special area, be cautious. It's much easier, much safer for you and the client, and you'll get a better result if you just bring in an accountant who lives in this space, like Christine, and there's others, but I don't find a huge number that really knows this area, and let them consult with you to make sure that these issues are dealt with properly. As firms get bigger in size, they tend to get partners, tax partners that specialize in different areas, like these issues that come up in probate and for decedents' estates and final returns. But just be careful. I think safety is a better result than going out on a limb if it's beyond really your area of expertise. I was just talking to a very well-known estate planner about the 6166 issues that I mentioned I had been looking at recently, and he claimed that he believes he's done more 6166 elections than any other estate planning attorney. And I think he said the number that he's actually seen in all his decades, many decades of practice, was something like a dozen. And, you know, Christine may see a lot more because she's in a big accounting firm and there may be more, but a lot of these issues don't come up very often. Not everybody can be an expert in, you know, all these black swan events that happen, you know, every 3 to 5 years or 10 years or something like that. The other area, and again, I think it's laudable that financial advisors, wealth advisors are getting more proactive in estate planning and income tax planning. But again, the same caution, you need to know your swim lane. Guiding clients to address tax planning is a wonderful thing for every financial advisor to do, so long as they know the limits of what they know. And sometimes people don't know what they don't know. But building awareness on the client's part, huge help, because too many clients don't go to the experts to get what they need. And the expert may be a CPA that specializes in this, Don't assume every estate planning attorney really deals with the income tax side, because many don't. The other piece of this is you don't want to get far over your skis. If you use any of the software products that you can feed information into and get, ideas, or if you're just using AI models and uploading, data on the estate, make sure it's confidential and it's a subscription. But that's a great way to have a conversation starter. But a lot of the information on AI, especially when you get into really nuanced areas, is just wrong. This 6166 matter that I looked at, the first thing I did, I had 3 questions posed to me by other specialists, and I put the questions into our proprietary subscription to AI, so it's confidential. All 3 answers it gave me were wrong. So you got to be careful. It may sound really intelligent and thoughtful when AI pops out something, but you're much better at this juncture still talking to a human being. And I think that's going to continue for a long time, because there's just not a lot of public-facing information on a lot of things that Christine's going to talk about, because a lot of it's behind firewalls. It's subscription-based services. So when AI scrapes, if that's the right term, the web looking for data, it can certainly access all the government and all the court cases. That's all public information. But the really astute journal articles, they're behind firewalls for tax planning journals, tax services, and so on and so forth. So I think I've made my caution enough, Christine. Let's get into this. But again, everybody should be involved: the attorney, the accountant, the financial advisor, insurance consultant, because there's a lot of insurance issues to address post-death if there's insurance coverages, and so on. Just make sure you have enough expertise on the team and focus on getting the right result for the client, not getting more business, because in the short run, I think you'll do much better. So Christine, why don't you start to
Sure.
start us off, and I'll comment periodically, but I'm going to kind of let you do your thing.
Okay, thanks, Marty. Starting off with the 1040 piece for decedent, then we'll get into the estate income tax return, but a couple of basic things on the final 1040. If the decedent was married in the year that he passed, that surviving spouse can still file married filing jointly. I've had some people ask me the question, they think the surviving spouse is automatically single. You still have married filing jointly filing status in that year of death. And then there's another filing status, it used to be called qualifying widower, now it's qualifying surviving spouse. If that surviving spouse also has a dependent, then you've got the next 2 years actually to use a qualifying surviving spouse status, which has tax rates that are equivalent of married filing jointly. So you don't want to overlook the QSS option, because again, that's favorable tax rates, and it'd be the equivalent of as filing jointly for those next 2 years after the decedent's death. The due date, there's nothing crazy there. It's the usual April 15th on the year following. So if someone passes away August 1st, it doesn't mean that now their tax return is due sooner. You would have until April 15th of the following year to either file or file the extension for October 15th. The Form 1310, I know there's been some misunderstandings on. This is a form that can be filed with the final tax return if there's a refund due, and there's a statement of person claiming refund due a deceased taxpayer. The surviving spouse doesn't need to file a 1310 with the married filing joint return. If you have an court-appointed executor, they don't need to file, then a 1310 doesn't need to be filed, because they'll attach their certificate to the final 1040. There are other circumstances. Say if you have a personal representative, they're not officially appointed by the court. If they're the person who has, let's say, possession and control over the decedent's assets, they need to file a Form 1310, fill it out correctly, and provide that with the tax return if there's a refund due back from the decedent's final return.
Christine, can you just elaborate a little bit about the person that has control over the assets? Would that be, for example, if somebody dies and there's a successor trustee under a revocable trust and they're really serving on behalf of the estate, would that cover them?
The trustee, and hopefully there's been an official appointment, plus they've got the document showing it, they could be, I guess that's still personal representative, but also trustee, which I think is a little higher level for them. But personal rep could be there's no executor appointed. Let's say somebody was named in the will and they're deceased, predeceased, the decedent, but they're might even just be the sole beneficiary of the estate. They're going to be receiving the assets and administering. They're now kind of in personal rep status. But definitely in that trustee situation, they've got some backup to it, but they would have that role as well.
Let me just make a comment on that, and I think we're going to see more and more of this, and we should. And this is something for all the advisors to consider at the pre-planning stage. And it may affect the post-death elections because of who may be involved. I'm guessing most, but I'd certainly say many of the probate or surrogates courts, different names in different counties and states around the country, the time delays to get an estate probated have gotten longer and longer and more difficult. So even though for many decades when people were suggesting, do revocable trust and other planning to avoid probate, maybe the probate system wasn't so difficult, it's gotten more difficult. But there's a much more worrisome point than the timing issue. The records in a surrogate court, like the wills that are filed, are public record. I don't know if that's true everywhere around the country, but it's certainly true in a lot, if not most places. That was worrisome enough, but unless you were somebody famous or important, I don't know that somebody would have gone down to the surrogates court when you died and looked up the microfiche to find, a will from you. But a lot of this stuff is now online. And I can't speak for every AI or what it can or can't do. We tried using the AI platform that we subscribe to, which is Copilot, if that matters. Can you access the surrogates court records to get copies of wills? And we were curious because we know it's public record and AI seems to be getting its tentacles into everything. We were told it can access it, but it won't disclose it because of privacy issues. I don't know what other AI platforms may say about that, but just pause for a second. Leaving aside cost or time delays of probate, wills are public record. And if any of these AI platforms can access them, we can't be sure that every AI platform may hold that information as confidential and not disclose it, which means any, not just curious person, but potential bad actor could start scraping through circuit court records to find people to contact, heirs, right? Look for specific bequests AI and give me a list of anyone that got 100 grand or more and their name and address. Well, that all may be possible. So I think we need to see a much more concerted effort to avoid and minimize probate, use revocable trust to keep privacy to the extent we can. And what's going to happen going forward is you're going to see far more frequently than in the past that the person handling a lot of this may be a successor trustee under revocable trust and not the typical situation of an executor or, as Christine mentioned, the sole beneficiary.
Those are good points. Yeah, and I know a lot of people have considered revocable trust just as soon as they hear, even before the AI concern. When you tell them it gives you privacy, that was a big concern of theirs. They don't want other relatives reading it to see who got what and things like that. Signing and mailing the return. If it's a surviving spouse filing, married filing joint, she can sign and write in the signature space filing as surviving spouse. Say if you had a single decedent, they passed away, and their executor is filing for them. The executor will file. They were attaching their court-appointed certificate to show their authority. But then this was interesting. I wasn't even sure of this myself. So many things get e-filed, and the decedent's final return could be e-filed as well. But that return would be mailed to the service center in which the executor lives. So not looking back to where the decedent was living, but where the executor is living. A request for prompt assessment of decedent's income taxes. It's the Form 4810. This is a good step to take in administering an estate because it's asking the IRS to kind of speed up their process of taking a look at those filed returns for the decedent. So instead of a 3-year statute, it brings it down to 18 months. So usually 18 months is a typical time frame for estate administration. So at least within that time frame, you'll get an answer and find out if there's any potential additional tax liability hanging out there. Because you wouldn't want to have distributed everything and then get a notice from the IRS and find out there's a problem. So the 4810 is a great tool to use to speed up that process, get it down to an 18-month window. And of course, it can only be filed after all the returns that you're requesting assessment on have been filed. So as long as the returns that you have on there have been filed, this will get processed by the IRS and they'll speed up the process. So you don't have something, as I said, popping out as a surprise down the road.
And that surprise could be particularly unpleasant. If you're the executor of an estate, and in the context of our prior comments, the successor trustee on the revocable trust serving in that function, and you've distributed estate assets, because a lot of beneficiaries, you know, the minute somebody passes, they're kind of clamoring at the gates to get money. If you've distributed all the money and an assessment comes from the IRS, you could be personally liable. So really, that's a very important step to take. And I think it could also be wise to inform the beneficiaries of that 18-month period. So let's say you even make a partial distribution, you know, you've at least informed them why. It's not me being holding on to your inheritance. I need to keep some money until we determine all liabilities, including the IRS. And a final point, that's why when you do make, let's say, an initial partial distribution, you have the beneficiary sign a receipt, release, and refunding bond in which they agree that, oh my, if there's a liability that the estate owes more money than it has, I will refund part of my inheritance that I've already received so that you can pay those expenses or liabilities. I really wouldn't count on that. I think what Christine said is much smarter. You want to get closure and finality on not just taxes, but all expenses, because imagine the difficulty of convincing a beneficiary who's already spent the money to refund it.
Exactly. So allocation of income and expenses between that final 1040 and the first estate income tax return, you're going to take from January 1st up to date of death on the 1040, thereafter on the 1041. And just keeping in mind that individual taxpayer is a cash basis taxpayer. So I have an example here of just dividends paid. If the person dies on October 1st, they own some shares of stock. They call it high tech in the example. If there's a dividend declared on September 15th to shareholders of record of September 30th, so he died on October 1st, so he still was the owner. The dividend of $2,500 was paid on October 6th. So that dividend should be reported on the estate income tax return, because as a cash basis taxpayer, he did not have it by the time that he passed on October 1st. So it gets picked up on his estate income tax return. However, and the note I have in the last paragraph is that most likely that 1099 div is going to be issued to the decedent in their individual name and their social security number. So to avoid notices from the IRS, because they'll do their 1099 matching, and if there's a problem, you're going to get a notice. When you do the final 1040, I would still show that dividend received, then back it out as a last nominee and put the EIN of the estate, or say if it was going to a beneficiary, put their social, but show the total because it's going to show up on a 1099 in the decedent's name and social, then back it out as last nominee and give the ID number of the nominee so that you're getting to zero, but at least that 2,500 in this example was there, and that should help avoid that automatic matching notice. So income received after, this is important, with jointly held accounts and payable-on-death accounts, you consider them to have cut off on the day that the person passed away. So even if that POD account hasn't been moved along to the beneficiary yet, to be, cross the T's and dot the I's, the income should just be from January 1st to the decedent's date of death. Income generated after date of death should be picked up by that person, the POD beneficiary, or by that joint owner. It should move over to them. For a married couple filing a 1040, it's all just going to stay there if it went by joint ownership to the surviving spouse. But in particular, with a joint owner who's not the spouse or a payable-on-death beneficiary, they should be picking up the income after date of death. Typically, what happens is that person wasn't notified. They've already filed their 1040. They didn't have the income on there, and you wind up either picking it up on the estate income tax return because they didn't. But the correct way is if you can get those people notified as soon as possible, make them aware they have to pick up the income on that asset from the time the person passed, so that they do have that included on their individual income tax return.
Christine, let me ask you a question, just kind of speculating. Would it be possible for the income tax cost on the 1041, the decedent's estate picking it up, to be higher than the income tax cost if it was properly reported, let's say a POD account, on I'll call it the POD beneficiary, but I'm not sure that's the correct term, on the POD beneficiary's return? So you could have the estate paying more income tax than the beneficiary getting it would pay. And if the beneficiary, let's say there was a niece, nephew, cousin that you had some specific accounts you wanted to leave to them, so instead of making a specific bequest in the will, you just set up some of your accounts as POD or transfer on death to, or joint, so that on death, they go to that niece, nephew, cousin, whatever. But now your children, who are the heirs of beneficiaries of your estate, they may actually end up getting a tax burden on that income if it's done incorrectly that's not fair to them. So that there's real consequences to what you just described in terms of how it's economically affecting the beneficiaries. Any thought or comment?
No, that's exactly right. You can have residual beneficiaries that are different than your POD beneficiaries. And if you put that income on the 1041, the residual beneficiaries are taking the hit. Not to mention on the 1041, once we get to around $16,000, I think it is for 2026, you're at the highest tax bracket.
Right.
Whereas that beneficiary, the individual who should have picked up that POD income, was probably, unless they're in the highest bracket, it would have been cheaper to have it in the correct place. But then it comes down to how much was involved. You're going to make them amend it. It's the best you can do is just quick communication as soon as possible. When you're aware of POD assets, make those beneficiaries aware that they're going to have some income they need to pick up, so that they don't say, well, I already filed my 1040 and all that kind of thing.
I do think advisors need to focus on this, because it's not uncommon with the evolution, if that's the appropriate word, of the American family unit, that you have different people that are getting gifts and bequests outside of the estate versus on the estate. Not to mention, what if the kids don't know that cousin Janie was getting a $100,000 bank account, and now they know because it was incorrectly reported there on an income tax return? You could have lots of negative consequences from not handling this stuff right.
Right. And I mentioned in the last part of the previous slide, similar to the issue before with the allocation of income, you're probably going to get a 1099 in the name of the decedent reporting a full year of income rather than cutting it off at the date of death for the POD. So you report it on the 10, if that's the case, you report it on their 1040 because it's in their name and social, then back out the portion that was after date of death, just to, again, avoid notices.
And keep in mind that if somebody without a lot of expertise in this area is doing the income tax return for the decedent and the decedent's estate, and they get 1099s with somebody's name on it, this sort of the logical thing without thought to do is just report it to wherever the 1099 said it went. But Christine has made very clear that in a number of situations that's wrong. And we've also demonstrated why it could have a material impact on other beneficiaries. So just be mindful, and that's why you do want to bring in somebody that has the expertise to handle this stuff.
The next slide, this is tax attributes of the final 1040. Certain tax attributes will die with the taxpayer, and some you can still get some benefit from in their year of death on the final 1040. So those that expire are charitable contribution carryover, investment interest, capital loss, minimum tax credit carryover, and unused NOL carryovers. They can be utilized in that on that final return. So even past their date of death, you don't have to split it out and say, what could I use when? It could be utilized on that final 1040 if a surviving spouse is filed, married, filing joint. Whatever's unused, if it belonged to the decedent, like a capital loss carryover, that's done. At the end of that year was unfortunately wasted. It doesn't carry over to the estate, and the surviving spouse should not continue to use it either. And this is important in entering information in your tax software. If you've got brokerage accounts that are taxpayer, spouse, joint, you want to code them correctly, because that's really the only shot you ever have at having a clue of how much capital loss carryover belongs to the husband, how much capital loss carryover belongs to the wife. Because truly, whoever passes, the amount of their carryover should not go on after the year of death. So if it hasn't been properly tracked, it's hard to figure out when you do finally need to know. Some exceptions to the expiring in the year of death. I just mentioned NOL generated in final 1040. I should have been more specific there. NOLs related to farming are still allowed a carry back. So if there was a farming NOL generated in the final year, you can still at least carry that back if it made sense and get use of it. It does not go forward. A business credit carryover could actually then be taken as a deduction instead if it wasn't utilized. Foreign tax credit carryovers have that possibility of going back 1 year, so you can look to see if it makes sense to carry foreign tax credit back if it can't be fully utilized in that final year. And then this is an important one, unused passive activity losses at the time of death. So if the decedent had some unused PALs, what you have to look to is the difference between, let's say it was on a rental property. So the difference between the step up that rental property is going to get and the amount of the PAL. If the PAL exceeded the step up, the excess can be taken as a deduction on the decedent's final return. So in the example that I have here on the slide, we have a property where with adjusted basis of 494,000, the fair market value at date of death, the step up is up to 500,000. So we have a $6,000 step up upon the decedent's passing, but the decedent had an unused PAL of 8,000. So that 8,000 is 2,000 in excess of our 6,000 step up. $2,000 can be used on the decedent's final 1040. It can be freed up and used to offset non-passive income. So it's something important to be aware of, because that's an income tax benefit on the final 1040 that could very easily be overlooked. Another tax attribute that people may not be aware of: married filing joint couple can get a $500,000 gain exclusion on sale of their primary residence. A surviving spouse has another 2 years to utilize that $500,000 exclusion, assuming he or she's not remarried at the time of the sale. And the other condition is that obviously the other requirements were met. You hit that 2 out of 5 years use as the residence was your primary residence and you owned it for that period of time. The decedent's ownership and use of it carries over to the surviving spouse. Say they got married shortly before the person passed, so the new spouse only lived in it a short period of time. The surviving spouse gets the decedent's use and ownership carried over. And so you've got another 2 for within 2 years of death. If there's a sale, then that $500,000 exclusion can still be utilized. And I think a lot of people may overlook that, or just, not be aware of that benefit as well.
Christine, if a house is owned jointly, husband and wife, how is that treated to determine the gain? Does that have any impact on this?
Well, you'd get your half step up if it was owned jointly, and then you'd be looking to see how much gain do I have after taking into account step up. And that's where that 500,000 could still come in handy, because there was still that the wife's basis being not recently stepped up would still have exposure and create gain, and you could use the 500,000 against it.
So we're killing off, for everyone's information, we're killing off the husband first in all our examples.
We do tend to do that.
but just to make sure people follow that, so if husband and wife, spouses, we're going to use husband and wife, it's just easier, own a home, the husband's half, because he died, gets a step up from whatever they paid to the current fair market value for half of the home. The wife's half does not get a step up, but if they then sell the house, she can use the home sale exclusion on her half, correct?
She can use that 500,000 to cover whatever gain, because even if there's a little bit of gain since date of death, like that step up half, but
Right.
Whatever gain results from that sale, between there's a step up on half, no step up on the other, that 500,000 can be used to cover that.
I vaguely remember, it's been decades, but there was a case, I think the name was Gallenstein.
Gallenstein.
Yeah, long ago, where if the couple bought a house in joint name, but one spouse paid for it, if it was bought before, I don't remember the year, 1967, something like that.
1977.
77, I can't believe you remember the year.
It comes up from time to time.
Very rarely, but it's a winner when you get it. You can get a full step up on it if the spouse that died paid for it.
Yes, because the presumption was you had a working spouse and a non-working spouse. So if the working spouse paid for it, they allowed a full step up for that non-working spouse. But I think it's for purchases of homes prior to 1977, which I've done a few in my career. They're getting obviously less and less as I go along, but that's what it would be applicable to.
Yeah, it's also a leave it to Beaver kind of view of family structure. So
yeah,
not something we're likely to see, but keep it in your toolkit, because like Christine said, you never know.
So another election is medical expenses. In the year that somebody passes, any medical expenses paid for them within the year of death can be taken on the final 1040. So if somebody passed away June 1st to 26, all the medical expenses paid through June 1st to 27 could actually be included and deducted on the decedent's final 1040. You're obviously going to look to see if it makes sense to do this. If there's a 706 and a state tax return being filed and you make this election, then the expenses can't be deducted on the 706 as a debt because you took them over on the 1040. So you want to look at the numbers and see what makes sense and where to take them. Without an estate tax return being filed, which is very often the case, the 706 wasn't required, then you can take this on the decedent's final 1040 and get some additional income tax benefit. And you would just make the election by attaching a statement in duplicate stating that you're doing that. And I think the next slide just gives an example of that.
Just keep in mind, everybody, that as Christine said, for the vast majority of taxpayers, there are no requirements to file a federal estate tax return. And we're not addressing state decoupled planning because a number of states still have much lower exemptions. But there are proposals floating now in Congress to lower the exemption to 3.5 million, and not inflation adjusted, a flat fixed 3.5 million. Should that happen, this election will be more complicated for a lot of people because you're going to evaluate which return to put it on. Whereas for most people with the states well under the 15 million, which is the vast majority of people, it's the only option is really the 1040. Here's the statement. I think this is great that you showed this, Christine, because a lot of people, what's a statement? What do I say? Well, here it is.
It's just a straightforward example, and just that they do ask for it in duplicate, but this is how you can easily then include those medical expenses for that year after death on the final 1040. Okay, another important election is with respect to U.S. savings bond interest. It's a Section 454 election. It applies to Series E and EE bonds. And what it is that on the decedent's final 1040, and again, I'll talk about what you want to look at to see if it makes sense. But on the decedent's final 1040, you can elect to recognize interest from date of acquisition to date of death, all that accrued interest. You can recognize it and pay tax on it on the decedent's final 1040. So if you've got beneficiaries that'll be receiving these bonds, or the estate itself it could be, and they're in a higher income tax bracket than the decedent is, and even with this election to include this interest, you're still going to be saving dollars. It makes a lot of sense to pick that interest income up on the final 1040, pay the tax, but then the next important step is you need to make the people who are getting those bonds, say if they had POD beneficiary designations, you want to make them aware of what you did, because otherwise, you kind of just miss the big bonus. You've included the interest income on the decedent's final 1040 from date of acquisition through date of death. You make the beneficiary of the bonds aware of that. So when the beneficiary cashes the bonds in, they're recognizing interest income from date of death to date that they redeem them. So a much smaller amount than these bonds could have been accruing interest for a very long period of time. If that's already been taxed, they just have to get taxed on the piece from date of death to the date they redeem them. So a very important election to consider, and very important to be communicating to that beneficiary that this was done.
Just a quick point. In many cases where an attorney is handling the estate, the attorney may be communicating only with the executor or personal representative or successor trustee, as the case may be, and not have an attorney-client relationship with the beneficiaries, and needs to be mindful that despite that, and this is not the first situation Christine has brought up, where communications with the beneficiary is critical. Depending on the circumstances, it may be that the financial advisor or accountant may want to make that communication instead of the attorney. But I think it's very important, as Christine said, to make these communications and address some of these details, because this is yet another example where the right elections and the right communications can save money. And no professional wants to be on the wrong end of that, where they've thrown away a tax benefit and then they're called later on the carpet for it.
I think the next page is just an example of how to show it on the tax return if you make the election. Okay, and then the last one, other issues. This was just kind of a miscellaneous assortment of other things to think about. If the decedent was 73 years of age or older, so they're in payout status for their retirement plans, they're getting their minimum required distributions, you need to ask the question, did they take their MRD for that year before they passed away? And if the answer is no, then you need to make sure the beneficiary of that plan is going to take it by 12/31 of that year. So you want to find out, did they take it? And if they didn't, somebody needs to take it by December 31st. If it happens to get missed, there's a Form 5329 that could be filed, because there's a penalty of 25% that could be assessed for not taking an MRD out of an account that should have been taken. The 5329 basically would explain the situation, ask the IRS to not assess the penalty. And of course, by the time you're filing that, you would have already wanted to correct the situation and have taken the MRD that should have been taken, so that you can state this was corrected on such and such a date. I really have yet to see the IRS deny one of these requests. They're fairly lenient with understanding that in the year of death, something got overlooked, something didn't happen. They've been pretty good about it. But the best thing is to just find out immediately, did they take that? And if they didn't, try to fix it by try to get it taken out by December 31st of the year of death.
And if somebody passed in Christmas time, I mean, you don't have a lot of time. You need to really, as Christine said, get on this.
Yeah, that's where thankfully that Form 5329 and correcting it as soon as you can, and the IRS being so far, from what I've seen, allowing it. They're not too crazy on assessing the penalty. They understand the circumstances. Federal estate tax deduction, I'm actually going to get into a little bit more on the estate income tax side, but it's, oh, sorry, Marty, I just wanted to get something else in there. The next thing is important, and this, I know we said we're talking about federal, but I just want to say this quickly for New Jersey people. There's an exclusion from New Jersey gross income tax for basically you get a basis step up in a retirement plan or an IRA if that plan, that asset, was subject to New Jersey inheritance tax. And I think a lot of people aren't aware of this. So if you have a New Jersey decedent, they passed away, their IRAs included, they had an inheritance tax return had to be filed based on who some of the beneficiaries were. That IRA now has a step up in basis to the value as of date of death. So when distributions come out to the beneficiary on the New Jersey income tax return, you get to have that, you can say that X amount of it was just a return of principal because of that step up basis, and then a small piece of it is subject to tax. It'll benefit you on the New Jersey return only, New Jersey return to recipient, but, beneficiary. But I just wanted to throw it in, even though we're mostly focusing on federal, because I think a lot of people overlook that. Okay. Now getting into, on the estate side, the Form 1041, the various elections for the estate. I listed them all here on the slide. We'll go through each one and just kind of have an overall discussion of each of them. So choice of fiscal year. This one's important because it's a planning opportunity. The choice that you make of which year you want to use for the estate, you can go from, oh, sorry, Marty, next slide. You can go from date of death up to the last day of the month prior to the date of death, because you can't go beyond like a 12-month year. So somebody passing away September 15th of 26 could have an estate fiscal year that ends as long as August 31st of 27. You don't have to pick that year. You have the opportunity to take a look at income and deductions and figure out what's the optimal year. But that initial year will set your year. Not when you apply for an EIN and you say, well, December 31st is the year end. That has not locked in your year. It's when you file that initial income tax return, whatever year you use, that's it. So now that's the fiscal year you're going to use, or maybe you went with calendar year. That goes forward to the estate ends. The final year of the estate could have a different year end because you're allowed a short year when you're wrapping up the estate and you want to finalize it. But very often I see people just go with calendar year for sake of ease, and they miss out on some great planning opportunities, especially opportunities for deferral. Because just to give an example, if you have an estate that has a November 30th year end, and that estate had an ownership interest in a partnership. So the partnership's going to crank out a K1 with a 12/31 year end. So if you have your 11/30/26 fiscal estate income tax return, you have a 12/31/26 partnership K1. That 12/31/26 K1 gets picked up on your 11/30/27 fiscal estate income tax return, because that's the year that includes December 31st. So you've actually gotten an almost full year of deferral just by having a different year end than what the partnership was on. So there's a lot of planning opportunities here, and in figuring out and determining what's the optimal fiscal year. You don't want to just default to calendar year for sake of ease. You can miss out on some great opportunities.
We've seen exactly what you said, Christine, many times, where no one gives any thought to it. They don't involve an accountant, and they just file everything on the December 31 year because that's what they think they're supposed to do, and they miss out on this opportunity, which could be material, especially if there's a large sale or liquidation or other transaction.
Right, and you want to, and at the same time matching up income and deductions. You don't want to have a whole bunch of accounting and legal fees paid in a year with a little bit of income, and if you had just done it a little differently, you could have had an offset. You'd hate to miss that. And then the next is talking about, so final year considerations, excess deductions on termination. Depending on the nature of those deductions, they could be something that the beneficiary gets to deduct because they'll get their K1 from that final estate income tax return. And if you had deductions in excess of income, that's an amount they might be able to deduct depending on what those excess deductions are comprised of. So miscellaneous itemized deductions, we know not deductible. Some deductions that fall under Section 67E, like fiduciary and executor commissions, court and probate fees, appraisal fees, those would be deductible as an itemized deduction for the individual. So that's something that would be separately highlighted on the estate K1 going out to them. And non-miscellaneous itemized deductions like state and local taxes, it would just depend. The person might already be fully utilizing their 10,000 or possibly, depending on their income now, 40,000 cap. So something passing through from the estate may or may not be useful to them, but it would still be highlighted on the K1 as a deduction that exceeded income in the final year.
Christine, does that 237th reduction apply to these?
That will apply also once it goes over to, because now it's final year, so nothing's staying in the estate, it's going over to the individual. That 237th would hit them on the Schedule A of the individual. And I actually do have a slide on that we're going to get into later. I definitely want to talk about that because that's up in the air right now.
A lot of confusion about it.
Yes. So just a few more things on this one. It's capital losses in the final year of the estate. They pass out to the beneficiary. So not to be confused with an individual's final 1040, where the capital losses will expire. In an estate, if you have capital losses that haven't been utilized and the estate is filing its final return, that'll pass out to the beneficiaries and they can take advantage of them on their individual income tax return. Interest in passive activity. From with an estate having an asset, say there was a rental property that came into the estate, a PAL has been generated in a couple of years, it's been in the estate for administration. That PAL is a basis adjustment to that property for the beneficiary receiving it. So if, say, there's a rental property, it's going to the son of the decedent, now that property is being distributed, you need to make him aware. Here's what date of death value was, because that's basis, but now here's also some PALs that were in the estate that weren't utilized, add that to that date of death value. That's really the basis to that individual inheriting the property. So again, don't want the PALs to be overlooked. They are a basis adjustment for the beneficiary receiving that asset that the PALs are related to. An NOL of the estate passes out to the beneficiaries. They can utilize them on their individual income tax returns. So again, not to confuse the things that expired on a final 1040, those same things on a 1041 can go out and go forward and benefit the beneficiaries. IRC 645 election. This is basically making the election to include a qualified revocable trust in the estate and treat it as one. Marty mentioned before how these are becoming more and more popular. This election is not something you want to overlook because there's quite a few advantages. One, and the easiest one, is now you're filing one income tax return, one 1041 for both the estate activity and the revocable trust, now irrevocable trust activity. But in addition to that, there's some elections that the trust can take advantage of because now it'll be considered to be an estate instead of a trust. One that I just discussed, the fiscal year. A trust on its own, the revocable trust that's now irrevocable because the grantor has passed, would have a calendar year, period, the end. That's it. They can have a calendar year. You make the election to include that trust in the estate. Now that trust will be taking advantage of the fiscal year that the estate has. So that's an important benefit of this. Administrative burden, I mentioned you file one tax return instead of two, and then the income tax provisions of being treated as an estate instead of a trust, I'll get into next.
Any attorney handling probate matters, I'm sure you see revocable trusts all the time. Make sure the 645 election is on your checklist for probate matters, because as Christine said, in most cases, you don't want to miss it. And if you're not familiar with this and some other things, bring in an accountant who's going to file the returns and understand these options or opportunities.
And in a moment, I'll get into, like, it has to be timely filed and all of that. So you certainly wouldn't want to figure it out after the fact because then you're done. It's got to be done on a timely filed return.
Do you want to talk about this slide or should I keep going?
Oh, no, I'm sorry. I just was talking because you just mentioned the don't overlook it, but I'll do this one. So one example of an income tax benefit that now the trust could have that it would not have otherwise had is if the estate or trust has a rental property in it, and assuming the decedent was had actively participated in that rental activity, for the first 2 years of the estate, you get to take the $25,000 of losses, if there are losses, against your ordinary income. It's not limited to just passive income. And this is the same for an individual. They allow you that $25,000 use of losses, assuming your income won't knock it out, for your active participation in a rental property. Now, if the trust had a rental property, if the elections were made to include it as the estate, the trust, they can take advantage of this. If the trust standing on its own was not included in the estate income tax return with the 645 election, it would not get this $25,000 loss benefit. S corporation stock, very important. If the trust owned an interest in an S corporation, which was fine as a revocable trust. It's a grantor trust, so that was okay during the decedent's lifetime. Now you have an irrevocable trust. You have a 2-year clock to do something with that S corp stock. Either qualify the trust to be an eligible S corp shareholder. There's the Quisita election or an Nesbitt election. Get the stock distributed to an eligible individual shareholder, but you have to do something within 2 years or you will invalidate that S election for that corporation. If the 645 election has been made and the trust is now being treated as an estate, you have the period of administration to handle that S corp stock and figure out what you need to do with it or have it distributed to the appropriate shareholder, but it gives you more time. It takes you off that clock.
I think, Christine, you may know better than I, but the last time I looked, the IRS estimated that I think it gets almost 2 million 1120S, subchapter S tax returns. So this is important because there's a lot of S corporations out there, even if the number I gave is a little dated. There's an awful lot of them.
And you want to, it's unfortunately, if you accidentally or inadvertently blow up that S election, there's a time frame, there's some automatic relief out there with a Rev Proc. They'll give you so many years to fix it. But if you get past that, and I think it might be 5 years, but don't quote me, you're in a PLR situation. That's an incredibly expensive way to have to try to fix a problem because you inadvertently blew up an S election.
You just want to avoid it if you can. And if making the 645 election helps, I don't think you want to miss it because the consequences can be pretty awful.
And then the last benefit is for funding a pecuniary bequest with non-cash property. So if there's a pecuniary bequest, a fixed dollar amount bequest that needs to be made out of the trust, and the trust uses an asset, piece of property to satisfy it, the trust has to recognize any gain on that because they're using a piece of property to satisfy, let's call it a debt, this pecuniary bequest to the beneficiary. If there was a loss in the trust, you can't deduct the loss. But 645 elections made, the trust is now being treated as an estate. As an estate, if there's actually a loss on using property to satisfy a pecuniary bequest, that's deductible. So those are the income tax advantages of having the trust included with the estate with this 645 election.
Just to emphasize what you just said, not on the loss for this election, but the main concept that if you have a bequest, I leave my niece Nancy 50 grand, and you use appreciated assets to pay it, you're triggering a gain because it's a dollar amount, as Christine explained, pecuniary bequest. And a lot of people get confused. Oh, there was a step up. Yeah, sure, there was a step up. So the estate gets an increase in its tax basis on the asset to the date of death. But if it takes you, and Christine, I think you mentioned a little while ago that 18 months is not an unreasonable period of time for estate administration. If over 18 months the market has gone up another 20%, you've just triggered some potentially significant gains on that.
Right, because you have to recognize the value at date of distribution and then look to the value at date of death as your basis. And if you have a gain there, you have to recognize it.
And that's another trap for the unwary that gets overlooked because, oh yeah, we got a step up. You did, but only to the date of death.
Exactly. Yeah, so that additional time you could have gains. And now with it treated as an estate, if it happened to be a loss, you get the advantage of that as well, the income tax benefit. Just quickly, because a moment ago, I think I mentioned something about 5 years and then you're into PLR. I think it's a lot sooner, 2 or 3 years. I don't want to, that's why I said don't quote me on that. But there's some Rev Proc relief for blowing up an S election. And once you're past that, you're in PLR territory. Making the election for 645. It checked the box on page 1 of the Form 1041. Include the trust EIN. This is important. A new EIN needed to be obtained after the decedent passed away. So even if this revocable trust, most of them have the decedent's social during the decedent's lifetime, but if it had its own EIN during the decedent's lifetime, now that the decedent has passed and the revocable trust is irrevocable, a new EIN needs to be obtained for that trust. And that's what gets reported on the Form 1041 when you're making the 645 election. There's a specific form for it. Oh, sorry, Marty, go ahead.
We tend to use, for not all, but most revocable trust, we get a tax ID number, which is not required. And as Christine said, it's perfectly fine in the norm to use a social security number. What we have found is that by getting a tax ID number, we believe, and I can't prove it, but my anecdotal evidence is it makes it harder for some of the perpetrators and predators out there to scam somebody, because when it's under a tax ID number that is not really public information. It's not really out there like your social security number is on all your medical records and so on and so forth. It just seems to perhaps minimize some of the elder financial abuse or identity theft. But as Christine points out, you're supposed to get a new tax ID number after passing when the revocable or formerly revocable trust becomes irrevocable. What if you don't do that and you keep using the same EIN?
I'll say I'm not sure because I've never done that. We always get the new EIN. I don't know if it would cause an issue with this election because you made it under the improper EIN. I would hope not, but I've always gotten them, so I'm not sure what could possibly go wrong then if you didn't. But I would be worried about this election then being made under the wrong ID number.
Good point.
Form 8855 is the form that you use to make the election. That gets attached to that initial income tax return. And as I was mentioning before, you don't want to overlook this. So it's the due date of the initial estate income tax return plus extensions is when this election needs to be made and filed. It can't be done late, so you have to get it done on a timely return. It's an irrevocable election once made. The election period, I just put some notes on the bottom. On the bottom there, begins on the date of the decedent's death and ends on the earlier of the day on which the electing trust and related state have distributed all their assets, or the day before the applicable date. On the next slide, I just gave an overview of what the applicable date is. This is getting into the weeds, but if a Form 706 was required to be filed, the applicable date's 2 years after the date, the later of, 2 years after the date of the decedent's death, or 6 months after the final determination of liability for estate tax. So 6 months after your closing letter was received. If a Form 706 was not required to be filed, then 2 years after the date of the decedent's death. But again, that's getting into the nitty gritty, but I did include that in the slides for you. 65-day election. I'm just going to pause because I think we might have lost Marty. Marty? Oh, there you are. So 65-day election, that's under Code Section 663B. It's available to estates and complex trusts. Oh, sorry, Marty, I think one more slide and then another. There we go. It's available to estates and complex trusts. And what this gives you is the ability to treat a distribution that's made in the first 65 days of the subsequent tax year as if it had been made in the prior tax year. So it's a great planning opportunity. I think I noted on here for this year, if you have a calendar year end estate or complex trust would be calendar year end. If you have a calendar year end estate, March 6th of 2027 would be the date by which you can make these distributions and then have them treated as if they were made in the prior year. And the reason you'd want to consider that is because the estates and trusts hit their highest income tax bracket at about $16,000 of taxable income, whereas most of your beneficiaries are not in that high of an income tax bracket. So you're looking at, all right, how much of a tax hit will we take in the estate if we don't distribute this income? What would the tax consequence be if it's distributed to the beneficiaries? And again, I'll say overall, you don't need the tax tail to wag the dog. You might have reasons why you don't want distributions going out to beneficiaries that will overrule the tax benefit. But it's good to take a look, make the trustee aware, this is some tax that could be saved, but this is something else that has to be done in conjunction with knowledge of the estate income tax return or the trust, and knowledge of what's going on in the beneficiaries' returns, or at least their income tax bracket, to figure out if you want to make this election.
This is a good value add point for financial advisors, because if you see that there's enough income in an estate or a trust to exceed the 16 grand, which is not much, you know, the client may not have even hired their accountant by day 65. So raise the issue, you know, early on in the following year, because that raising it may be enough to motivate the people responsible to talk to their accountant or the estate's accountant or the trust's accountant and engage in some of this planning. And the arbitrage between, you know, the maximum 37% rate plus 3.8% on an estate or trust versus what the beneficiaries may have as their marginal bracket could be material. And there also may be a state tax swing, right? You may have an estate of a decedent that died in New York and New Jersey, which has high taxes, And maybe one of the beneficiaries is smart and lives in, Nevada or Florida or someplace where there's low or no taxes.
Yes, exactly. State tax savings as well. So you could be looking at it, suggest it to the trustee. They might tell you up front, we don't want to distribute for whatever reason. No, it's okay. But if they're open to it, then at least looking at it and giving them the option and letting them know what could have been saved is a great planning opportunity.
And you don't have to be the expert on this as a financial advisor. You just have to be alert to, hey, you're well over the 16 grand. Talk to your accountant.
Right. Just be aware that it's out there as an option. And it's not an all or nothing. So let's say you make the election. It's not that everything you distribute in the first 65 days of the next year has to then be brought back to the prior year. You can choose the amount that you want to use for the planning that you're trying to do. There is a maximum. You can't make the election for more than the greater of the fiduciary accounting income or the distributable net income of the estate or trust. That's what your cap is, but you're not locked into everything that was distributed in the first 65 days must be pulled back. And to make the election, you check the box on the other information section in the Form 1041, and this is just a sample election.
Again, I love that you did this, because so often when people, what's an election? Am I voting? No, it's a statement you attach to the return, and it's not that complicated. But the consequences of not doing it is bad.
Right. Little roadmaps help. So Code Section 643E3, this is property distributions. So the general rule is no gain or loss is recognized if you're going to be distributing an asset out of the estate to the beneficiary. The pecuniary bequest is an exception, but just say distributing an asset to a residual beneficiary, it's a piece of property, whatever, you don't have to recognize gain or loss. But the executor does have the option to make an election to recognize gain or loss, or excuse me, gain but not loss on that distribution. So if you want to if you're distributing property to a beneficiary and you decide you make this election, you'd be looking at date of death value to the value at date of distribution, and then recording that gain and paying tax on it at the estate level. And we can flip along, and I'll explain to you circumstances where you might want to do that. Before I get into the reasons and the benefits, you're basically treating the asset as if it was sold. So in this case, we don't get to take the loss, but we would recognize a gain. The estate would pay the tax on the gain. And now that beneficiary gets a holding period that starts with date of distribution and gets a basis that's equal to the fair market value of date of distribution, because the asset was just treated as if it had been sold. The loss is realized but not recognized by the estate. It's not allowed in this circumstance. And the beneficiary then needs to keep track of two bases, and I put this information in the slide to be aware of. The estate's basis in the asset will be used to compute a gain on the asset's disposition by the beneficiary. The fair market value of the asset will be used to compute the loss on the disposition. If the beneficiary happens to sell the asset in between those two, there's no gain or loss recognized. So this is because the loss itself wasn't recognized at the estate. We have to actually track it to see what happens upon the sale by the beneficiary. And some reasons why this election is helpful is, holding period, as I mentioned, holding period begins on date of distribution because it's been treated as if it was sold. Making the election is you check the box in the other information section on page 3 of the 1041. You report the sale on Schedule D. I would include IRC Section 643E3 in the description of the asset sale, highlight that that's what this is, the gain is resulting from. But once you make the election, it applies to all distributions of property made during that year. So if you're distributing a piece of land to one beneficiary, we call it a piece of land to another beneficiary, you make this election, it applies to both. You'd be recognizing any gain on either of those distributions. And it comes in handy for equalizing amongst beneficiaries. So now if you've recognized built-in gain on the assets, really everybody's being treated fairly. They're getting you're looking just at fair market value in terms of what are they receiving. Not, well, this one got a piece of land worth X dollars, but oh, guess what? It also has a built-in gain in it, so that's not fair to them. You've kind of equalized that by making the election and having the estate pay the gain. Sorry, this is on the next slide, Marty. It comes in handy if the estate has capital losses or some unused deductions that can help offset those gains. So you want to look at that too, is if we take this gain into the estate, but then if there's something else there to offset it, then it's a freebie. You're getting an extra step up for the beneficiary, and those losses help to get rid of that gain. As I mentioned, beneficiary might plan to sell the asset, and if there's built-in unrealized gain at the time of the distribution, the estate makes the election, and the estate's really taking the hit. But we have to look at the whole picture. if there's multiple beneficiaries, and who else is going to be sharing in the tax on that gain. So it's definitely, it's not a tunnel vision election. You're looking at the ripple effect on everybody when we make it. And sometimes across the board, it winds up being beneficial for all the beneficiaries so that they know they're getting their fair market value with no built-in gains coming along with the asset. But quite a bit of analysis goes into seeing if it makes sense, but it can be a very useful election and save some tax dollars. It's good planning if it fits the facts and circumstances.
Couple of quick comments. Just sort of pausing and stepping back. A lot of the stuff that Christine has talked about is very nuanced, and a lot of it will not apply to many, maybe even most estates. But I think one of the take-home points is all these little nuanced things, when you pick and choose the ones that really can help a particular estate, you may find that you can have really substantive tax differences. And I'm not talking about estate tax. A lot of people tune all this out because, oh, it's the big exemption. This is income tax benefits. So attention to these seemingly minute, complex, nuanced tax elections can really have a material difference to an awful lot of people with estates well below the $15 million exemption. The other piece, and we talked about this earlier, but I just want to reinforce it because it's so important. There needs to be ongoing communication because you need information to make the analyses on this and other points that Christine talked about from the beneficiaries. And you also want to communicate to the beneficiaries because it may affect what they do on their own tax filings and when they do it and so on and so forth. So one of the things that we've done with a lot of estates, and we do it sort of as a planning team with the accountants, with the wealth advisor, with often the insurance consultant, we send out what we kind of generically call a family update letter. So it's not monthly or quarterly, it's whenever some events occur or new information is available. But we try to send a letter to all the people involved that all the advisors had input on, so we can let everyone know whatever we are thinking of. And honestly, I would even let people know if a decision is made, for example, by the accountant, that a particular election is not going to be beneficial. I'd explain that too, because listen, if you put everybody on notice and they don't say anything, it's a little hard for them to give somebody, one of the advisors or the executor, a hard time later. Hey, we told you why we weren't doing it. If you had your own accountant, why didn't you have them speak up then? Communication's really important.
It is. I think most of the elections we've talked about involve the estate and the beneficiary, and does it make sense? The estate tax deduction, this was mentioned earlier in the 1040 part, but I wanted to get into it more here. It's an income tax deduction that's allowed for an estate tax that was paid on an income in respect of decedent item. So IRD items are subject to estate tax in the decedent's estate, and then subject again to income tax when the beneficiary receives them. So perfect examples on the right-hand side: IRA distributions, 401k distributions, etc. Those assets were subject to the estate tax if there was a federal estate tax filing requirement and tax due. If they were subject to a federal estate tax, now when the distributions come out of them, they're subject to income tax to that beneficiary. The 691C deduction allows that beneficiary to take a deduction for that estate tax. You don't get the full amount of the estate tax that was due on the asset in the first year. It kind of gets prorated over time as you take the distributions out. I think it gets into it on the next slide. As you take distributions out of that IRA or 401k, you're doing a computation to figure out, okay, there was X amount of estate tax paid. This is the value of the asset. Here's how much distribution there is. And there's like a pro rata allocation that helps you determine, here's how much of a deduction I can take on my individual income tax return for some estate tax that got paid on this asset. So again, not that it pops up too often anymore, because not a lot of states are having an estate tax liability, but when it does, you do not want to overlook it. This is a benefit to that beneficiary of that asset to get this deduction for some estate tax that was paid.
If you're a young professional and you've been practicing for, say, 10 years, we've had some pretty high exemptions for a while now. And if it turns out that they do enact legislation, and it's pending now, it's been proposed, I'm sure it won't go through now, but it very well may after one of the next elections. If we end up with a $3.5 million non-inflation adjusted exemption in another decade, $3.5 million non-inflation adjusted, maybe a little over 2 million and change. So where you grew up in the profession not having 691C issues on many, maybe most, maybe none of your clients, All these things could become much more important if we get a lowering of the exemption. So it's not just that, oh my, we have to do estate tax planning when the exemption gets lowered. It's going to affect a lot of the decisions that Christine is talking about. And newer professionals are going to have to get up to speed because they may never have seen this stuff.
Right. It's the key thing is going to be an awareness. Like, do you know what's out there? Do you know what you could be taking the benefit of? And on the last example, I mentioned the individual beneficiary taking the 691C deduction on their 1040. It applies to the estate as well. If the beneficiary, the IRA or the 401k or whatever the IRD asset was, is the estate, then on the estate income tax return, the 1041, that's where the 691C deduction can be taken. So another bit of analysis is deducting expenses on the Form 1041, the estate income tax return, versus the estate tax return. As we've been saying, we see less and less of these 706s, but this is still just something to be mindful of. Where are you going to get the most benefit? There's certain deductions that can be taken on either the 1041 or the 706, but not both. So when considering these, you want to look at limitations like certain, itemized deductions. If you're taking that on the 1041, they're disallowed right now. You're not going to get a benefit. If there's tax exempt income in the estate, that's going to be a bit of a haircut on your deductions on the estate income tax return. For any deductions that are allocable to tax exempt income, they get reduced a little bit. We're going to get into that 237th rule. That's my last slide. We'll be talking about that in a bit. Consider the timing of the payment versus income recognition. If you decide you want to take some deductions on your 1041, start looking at, well, when are they going to be paid and how much income will I have within that same fiscal year? Am I really going to get much of a benefit on it, or am I better off with it on the estate tax return? And then this last one is very important. Consider the impact on the marital deduction or charitable deductions on the 706. So there's estate transmission expenses and there's estate management expenses. I'm going to discuss them in a moment, but this is important where some people don't pay attention to the fact that you just paid some expenses. If you don't deduct them, here we can flip to the next slide because I think I get into it a little bit there. If you, estate transmission expenses, like these have been incurred because somebody has passed away. That's the reason these expenses are there. So your executor commissions, legal fees, and I can't believe I left this off, accounting fees, hello, probate fees. How did I miss that? Probate
maybe,
fees.
Maybe you like to work for free, Christine, I don't know.
No. Probate fees and appraisal fees, those are your expenses that are incurred because somebody's passed away, the estate had to pay these things. If they're paid from the marital or charitable property, then that estate tax marital or charitable deduction must be reduced. If that expense has been, if there's a decision that's been made to take it on the Form 1041 on the estate income tax return, then now you're going to have a reduction in your marital or charitable deduction without an offsetting other deduction to make it a wash. So I've seen this on 706s before. If you have a marital deduction and there's been accounting fees and executor commissions, legal fees, and the decision was made to deduct them on the Form 1041, because that's when there'll be a benefit because there's no tax due on the 706, everything's under marital deduction. They're missing the fact that you have to reduce that marital deduction now by the amounts that were used to pay the executor commissions and the legal fees and et cetera, because obviously that money didn't go to the spouse, so you shouldn't be taking the marital deduction. So there should be an offsetting reduction to that marital deduction for those amounts that are not being deducted on the 706. They're taken on the 1041. And that in turn will also affect your DSUI if there's a portability election being made. So it's an important thing to pay attention to that, okay, we're not going to take these deductions over here. We don't see a benefit. We won't take them on the 706, but you've just affected your marital deduction, possibly, especially if they're transmission expenses, then definitely. And you need to pay attention to that. Make the proper adjustment to that marital deduction, which will slightly increase the taxable estate. It'll reduce the DSUI. It has that ripple effect, but you don't want to overlook it and have the IRS come back and point that out to you. So this is very important to be mindful of.
Just tell everyone what DSUI stands for, because some people may not
sure.
know DSUI.
Sure, I'm sorry.
I know we do, but just let's be nice to everyone else, just in case.
Sure. The deceased spouse's unused exemption. That's what everybody refers to as DSUI. That's the amount that you can make a portability election and carry that unused exemption over to the surviving spouse. So when I was saying that this reduced marital deduction, that also has the impact of increasing the DSUI because it's now decreasing the DSUI because now you've got less exemption left. Yeah, sorry, I threw DSUI out there without explaining. Management expenses, a lot of these are not deductible now on the income tax return. They're investment advisory fees, brokerage commissions, custodial fees, but the last one, interest, would still fall into a bucket of possibly it benefits you on the estate income tax return more than it might on the estate tax return. But with estate management expenses, we want to pay attention to what impact does that have on our marital or charitable deductions. And I think if we flip to the next slide, I kind of laid it out on here.
Christine,
Oh, sure.
do you see many clients trying sort of a lender bagel structure where they are creating like a family office and an entity to handle investments as a business to try to deduct these fees? Do you see much of that?
I have seen more of that happening to get around this whole disallowed miscellaneous itemized deductions is treated as a family office, or as you said, like a business, so that they can get some tax benefit from these type of deductions because they become business expenses instead of miscellaneous itemized expenses. I have seen that.
Yeah, everyone should keep that in mind. It's complicated to do, and you need enough investment assets to make the cost of setting up the structure worthwhile.
And so this slide has a lot of detail about the management expenses and the impact they would have on the marital or charitable. So honestly, I just kind of put this in there for your review and to just keep in mind when you're doing that, it's when you decide I'm going to take this deduction on the 1041, really think about what you just did to your marital and charitable over on your 706. And I think my next slide is where we get into, there's some deductions that could be taken, as I mentioned, either on the 706 or the 1041. That's the executive commissions, legal and accounting fees, appraisal fees, and probate fees. Some expenses can be taken on both returns. So similar where we had income in respect of decedent or IRD type assets, there are deductions in respect of decedent. These are things that if the decedent had been liable for the expense as of his or her death, and they fall into this category, they can be deducted on both the estate and they can be deducted on the estate income tax return. So things like the business expenses allowable under 162, interest expense, some taxes allowable under 164, investment expenses. If the decedent was liable for these at his or her date of death, you actually are falling into a DRG bucket, and you can take them on both your estate tax return and your estate income tax return. And as far as when you make this decision as to where you're going to deduct them, if the decision is made to take some of these expenses on the estate income tax return, it's an election statement that should be attached to the estate income tax return, making the statement that the following expenses are being deducted here. What I will say, we refer to it as an estate tax affidavit. What I will say here is that what you want to keep in mind is when you're filing the 1041 and attaching this statement, you're definitively saying we're taking these deductions over here on the income tax return and not on the 706. If that estate has not received its closing letter yet, and let's say the IRS should audit the estate, the 706, now these deductions were locked in and taken on the 1041. You can't then opt to have them taken over on the 706 to help mitigate any audit changes. So what you can do is file the estate income tax return, take the deductions because that's what you want them to be, don't attach the affidavit. You can wait, get your estate tax closing letter so that now you know you won't need to pull these expenses off of the 1041 and put them over on the 706. File the affidavit before your statute of limitations runs out on the 1041 itself. Because in that circumstance, you've taken the deductions, but you didn't include the affidavit. Now you have an estate audit. You decide you want some of those deductions over on the 706 to save the tax, the 40% rate over there. You can just amend your 1041, remove the deductions from that return, take the expenses on the 706. If this affidavit had been there, you're locked in, you're done. So you want to watch your estate tax closing. Okay.
Would you report those on the 706 if you really want them on the 1041 if there's no estate tax audit adjustment, or you only report them on the 1041 without the affidavit?
Wait, I'm not, just say it again. I want to make sure I understood your question.
What would you report on the 706 initially? You would not report these deductions because you're intending to keep them on the 1041. But yes, if there's an audit adjustment, then you say, hey, IRS, we didn't file the affidavit on the 1041. We're bringing them back to the estate to wipe out the estate or lower the estate tax.
Right. We have some deductions we didn't take that we want to take now. And we filed the 1041, but not with the affidavit, not locking it in. So you'd have to also then amend your 1041 because you're not going to get the double dip. If you pull those over to the 706, you amend the 1041, remove those deductions.
When you first file the 706, I haven't heard this before. This is very clever. If you first file the 706 with no tax due because there hasn't been an adjustment yet, would you say anything about these expenses on the 706? Like, hey, these expenses were incurred, but we reported them on the 1041, but without the, would you say anything on the 706?
I have not. I've not disclosed on a 706 that there were deductions that weren't taken. I'm not saying maybe somebody does, or I've never done it in practice, but we do on the 1041. We won't attach the affidavit until we know we've got a closing letter on the 706. And then it's just an additional filing of that affidavit once you know you're good to go on the estate tax side.
And do you say anything about intentionally not filing the affidavit on the 1041, or you just put the expenses, no affidavit, you don't say anything?
Just put the expenses, no affidavit.
Okay.
But if you've got a situation, yeah, if you have a situation where, let's say you have your closing letter when you're filing or something, then you can put your affidavit in, you're done, you don't have to worry about going back and doing it later, it's all taken care of. You just don't want to box yourself in until you know the IRS isn't going to do anything to your 706.
Christine, we really have to wrap up, but I'd like you to talk about the 237s. And for everyone listening, if you attend any summer barbecue, this is the topic to really get everyone excited talking about.
Yes, I kind of cruised through a couple of other things because I wanted to make sure we had a little bit of time for this. The 237th rule, which came from the OBBBA, which is easier to say OB3, is this basically similar to what used to be the P's limitation. It's a haircut on the individual income tax returns, itemized deductions, which essentially is going to wind up, I think, being a 5.41% reduction to itemized deductions for people in the highest bracket. The issue we're having on the trust and estate side is that the IRS removed the exception, like where P's limitations used to exist, and there would be a reduction to itemized deductions on a 1040, estates and trusts were accepted from that. Now, there's no language there in the OB3 accepting or excluding trusts and estates from this 237th haircut. So I know we need some additional guidance, we're hoping for some clarification, but as of right now, it looks like this does apply to trusts and estates. And so the questions are, first of all, a trust and estate will get hit harder because we hit the 37% bracket at $16,000 of taxable income. So this would be a much harder impact on a trust or estate than it would be to an individual who hits it somewhere between, I guess, 400,000 or 600,000, depending on what your filing status is. And then we have to wonder, what's it going to apply to? If it's applicable to a charitable deduction on an estate or a trust, let's say you've got an estate that the 100% residual goes to a charity. So at each year, when you have your income, whether or not it was distributed, you would take an offsetting charitable deduction saying it's distributed or set aside for charity. If now we're going to have a 237th reduction to that, you could wind up with some tax due on an estate income tax return where everything in that estate is going to go to charity. That's not a good result. Another question is, will this haircut apply to the D&I deduction, the distribution deduction? Again, that's huge. You can have an estate or a trust, and if this reduction happens, now you've got your D&I deduction for amounts of income that were distributed to the beneficiary. Beneficiary is getting a K1 with bits of income reported on it that total up to their portion of D&I. Normally, now your trust, let's say, or estate has a deduction for that D&I. You're essentially moving that portion of income over to an individual to be reported on their 1040. But if there's a haircut on the D&I deduction, we're going to have some double tax going on, because some of that D&I that got reported on a K1 to a beneficiary gets taxed to them, but now the estate or trust is also going to get taxed on, like this 5% of it or so, in addition to that beneficiary paying tax on all of it. So these are the things we're waiting for some clarification on. We're hoping it comes back that they meant to exempt trust and estates, but the way it's written right now, that 237th reduction is applicable to trust and estates.
This is what Christine just described, defies logic, at least as far as I can see, but it's also potentially just a mess. And especially where you have charitable trusts, it's going to be really complicated. So, any advisor that's not staying on top of this, make sure to get somebody involved that is, because it's not only going to affect the income tax reporting, cash flow projections, what happens with, beneficiaries' expectations. It's really a mess.
So I put the date at the, oh, sorry, go ahead.
No, I think we all hope that they'll say, no, it wasn't intended to apply to trusts and estates, but we don't know that. Right,
and I intentionally put that date at the bottom of the slide, so if you're looking back at this months from now, just go online and check, look for an update, look for any changes to this. As Marty said, we're hoping we'll kind of get something equivalent to our bad. Didn't mean to do that, but right now that's the way it is.
So Christine, we got to wrap up. I know you could have used a little more time, but I thought this was great, really practical. I think you've really driven home the point that this is, it's like the commercials on TV for the folks with the cars, right? Closed course professional driver, don't try this on your own. And I really do think the complexity and the details and the nuances are such that every advisor should be wary. And for clients that think they're going to handle their own estates, you miss one of these elections, it's probably it would have paid to have hired a professional. So everyone keep that in mind. I hope you found this as interesting as I did, and please let us, both me and Christine, know how your summer barbecues go when you talk about the 237th reduction and how that's received. We know everyone's going to be fascinated. So thank you for joining us, and Christine, thank you again, and I appreciate it.